Accounting equation and Excel. Create reports after second month of data input. Get ready and some coffee because we're about to learn the accounting foundation, the accounting equation, using Excel. Here we are in Excel. If you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you could begin back there or just construct your own worksheet as we go, or possibly just follow along with good old paper. First, a word from our sponsor. Yeah, actually, we're sponsoring ourselves on this one because apparently the merchandisers, they don't want to be seen with us. But that's okay, whatever, because our merchandise is better than their stupid stuff anyways. Like our CPA 6-pack shirts, a must-have for any pool or beach time. Mixing money with muscle, always sure to attract attention. Yeah, even if you're not a CPA, you need this shirt so you can like pull in that iconic CPA 6-pack stomach muscle vibe, man. You know, that CPA 6-pack everyone envisions in their mind when they think CPA. You know, as a CPA, I actually and unusually don't have tremendous abs. However, I was blessed with a whole lot of belly hair. Yeah, allowing me to sculpt the hair into a nice CPA 6-pack like shape, which is highly attractive. Yeah, maybe the shirt will help you generate some belly hair too. And if it does, make sure to let me know. Maybe I'll try wearing it on my head. And yes, I know 6-pack isn't spelled right, but 3 letters is more efficient than 4, so I trimmed it down a bit, okay? It's an improvement. If you would like a commercial-free experience, consider subscribing to our website at accountinginstruction.com or accountinginstruction.thinkific.com. Pencil. If you do have access to this workbook, though, 4 tabs down below. Example, month 1, practice, month 2, example. In essence, the answer key, month 1, prior month of operations, the practice tab having pre-formatted cells so you can practice the practice problem with less Excel formatting. Month 2 tab, the one that we will be working in, current month of operations, started with a blank worksheet, but it's basically working from a template at this time. However, we will be adding to that template as needed as we go, practicing our Excel tools and formatting as we do so. Let's go to the example tab to get an idea of what we will be doing, basically building our bookkeeping system using the accounting equation as, in essence, our trial balance from which we construct our major financial statements, balance sheet, income statement, statement of equity, noting sometimes that income statement can be called the profit and loss report. And that's what we're going to do this time. We've entered our second round of data or data input for the second month of operations. These are our totals down below. What I'd like to do now is take those totals, and we're going to scroll all the way to the right and construct our financial statements from them, moving them from simply an accounting equation format to financial statements, balance sheet, income statement, statement of equity. We're not really focused on the statement of cash flows at this point in time. We have a whole nother course kind of on the statement of cash flows, creating the statement of cash flows being a little bit tricky to kind of do. There's a couple different formattings to do it. And one of the reasons I don't focus on it right here is because these are the major financial statements you usually make directly from kind of a trial balance, whereas the statement of cash flows, you kind of make them after you make the financial statement or income statement when you think of the order of operations of creation, because you are in essence making a statement on kind of a cash flow basis, of course, rather than an accrual basis, which is what we've mainly constructed the financial statements from. So that's a whole topic in and of itself. It's a good topic in terms of how to construct the statement of cash flows, but our major focus right now, balance sheet, income statement, statement of equities. All right, so to do that, we're going to pull in our, in essence, accounting equation, put it in a vertical fashion. We started the report for last month, last time, so we're just going to reformat them, taking the current month's data into account. Let's go into the current month. There's going to be some Excel formatting to do this, some good old Excel tricks that we will learn as we go. So let's see what we have thus far over there in the financial statement area. So I'm going to go up top first, View tab. Let's unfreeze the panes. We don't need the frozen bit. That's going to mess us up. So we'll unfreeze the panes. Then I'm going to scroll all the way to the right to where our financial statement calculations are located. Last time, at the end of last month, we took our financial statement numbers, or our accounting equation numbers, into a vertical format like this, used them to create the balance sheet, which is the report as of a point in time, the income statement, timing report, and the statement of equity. Now 2 months have passed. So notice what would happen if 2 months passed. The balance sheet is what it is because it is as of a point in time. We could process the income statement for the 2 months of operations, meaning an income statement, how well did we do, how far did we go in terms of revenue and net income over 2 month time period, or we can think of it as closing out month number 1 and running a report for 1 month. Now remember that as we're looking at this in like what I would call like a 2-dimensional Excel sheet, we have to kind of make a choice. We have less options basically to just switch between income statements of a 2 months versus a 1 month, and so on and so forth. Whereas in a what I would call a 3-dimensional database program like a Xero or a QuickBooks, then I can easily switch the dates of an income statement to run for 1 month or to run for 2 months, or I can have a comparative income statement, January, February, subtracting the two of them, possibly looking at the difference between the two of them. So that is a great thing to be able to do, but to understand what is happening, the relationship between the reports, balance sheet, income statement, statement of equity, really useful to actually build them this way, because we need to know that that income statement feeds into the equity in some ways. And if that happens, then how do we stay in balance in the equity when I run the income statement for multiple time periods, right? And the answer is the closing process that takes place, noting that QuickBooks basically does the quote closing process for us, but it does it in essence on a yearly basis. Also note, and that's with Xero too, also note that it doesn't normally give us a statement of equity because it basically puts in the balance sheet the statement of equity information in here, including the current net income into that equity section. So that's something we want to kind of keep an eye on and see where that is beneficial and where that makes complications, and how that affects when I run multiple reports for multiple time periods, monthly versus yearly, for example, as well as comparative reports. All right, so what I want to do is I want to fix this to give us the current information and add any accounts that have been added. So I'm first going to hide from all the financial statements from EV on over to FJ. And I'm just going to right click. I'm not going to delete them. I'm just going to hide them so that we can adjust them. And then I'm going to go all the way back to my trial balance over here. So I'm going to go back to my trial balance, and I'm going to copy this top bit. And then what I'm going to do is I'm going to scroll all the way back as it is highlighted. I'm going to scroll down to the bottom where the end is. And then here's the bottom bit. I'm going to hold down Control and select these down here. So I'm holding down Control, allowing me to select two non-adjacent or not next to each other areas. So now this is highlighted and this is highlighted at the same time. Going to right click on one of those highlighted areas, copy it, or you can just say Control C, and then I'm going to scroll all the way up to the top, and I'm going to scroll all the way to the right where we want to be, and I'm going to put that up at the top here. So I'm going to put it in, let's put it right here in FM1. Right click, but I'm going to paste it special, just the values only. I don't want the formulas because the formulas will not pull over properly here. So we'll paste it, and there's all of our numbers. So that's great. I want to put it in a vertical format now. So I'm going to select this bit first. I'm going to just go over here and say, let's copy that. So I'm not going to cut it right now. I'm going to copy it, and I'm going to paste it right here to look at the formatting pasting it special. So I know I want to switch the axes to be vertical rather than horizontal. I can paste special and do this tricky transpose. The tricky transpose. Boom. There it is. Now I'll make this a little longer so I could see it. So now we have it. So now I'm just going to copy all the numbers and do the same with them. I'm going to copy these, Control C, and then I will put them right here, right next to the cash, and paste it special, but transpose. Bam. There it is. All right, now I can delete this stuff. We don't need this anymore. This has served its purpose. Now it will be deleted. Ha 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 ha. So anyway, so now what I'm going to do is I'm going to move this on top over here. Instead of trying to like adjust each of these ones, I'm just going to pull this over here, which will mess up all of the formulas in our worksheet of our financial statements, and then I'll go in and just adjust them. But the formatting should still be useful. So I'm going to select all of this, and I could cut and paste it, but I'm just going to drag it. So I'm just going to put my cursor up on here and just drag it on top. It's going to say, hey, there's something there already. And I'm like, there's already data here. Did you want to replace it? And we're going to say, yes, we do. Replace it. And then I'll recolor code it, making it green, red, and blue. The assets up top before the equal sign, we're going to make is green. And then I'll make white for the text. And then maybe this one was the light green. Let's make those a different green. That's going to be the lighter green. And I think we had the black text to make them stand out. And then this one's kind of funny because I'm going to say that these are going to be the current liabilities from there to there. I'll make them the darker red. Is that what we did? And then these from here to here, I'm going to make and then I'll make this red and white. Let's go to the Home tab, make it red and white. These two loans, I'm just going to put them into the long-term liability for now. We'll talk about adjusting entries later, but I'll put these into long-term. So this one should have been a darker red. Isn't there a darker red? Like that red. Okay. So then we got the equity section, which is from here to here. Now the equity section is a little tricky because remember, in one sense, all of this is equity on the balance sheet. But we broke out the current activities starting on the income statement, which is the income accounts, these three. This is all part of the income statement, which is going to roll in or close into the equity on the balance sheet. So I'm going to highlight this differently. This one's going to be the dark blue, which is going to be the balance sheet accounts, dark blue and white. And then we'll make this the light blue to distinguish the income statement, lighter blue at least, and white. So there we go. All right, so now let's put some borders around this for formatting's sake. And we're going to go Home tab, font group for formatting's sakes. Border that, baby. And then let's unhide. So I'm going to go from the ET phone home column to the FK and right click and unhide. All right, so now we have our balance sheet, which has all been reformatted with these references because I deleted all of the cells. So now, under current assets, that's going to be all the light green ones. So I'll just pull those in. So I'm just going to say this equals. Now, I might not need to pull in undeposited funds. I should probably start with accounts receivable. That would be the better way to go, possibly. So maybe I'll do that this time. I'll say accounts receivable because there's nothing in undeposited funds. And we'll copy that down. I'll select these two, copy it down. Notice the formatting where it has it indented with a colon. And then it's indented here as well. And then, hold on a second. Total current assets. It seems like there's less than there was before. What is going on? Let me do that again. Copy that down. Okay. And then I'm going to delete it from here. This is furniture and equipment. don't need those two. We just need these. Okay, what am I doing here? I have to have cash in there, for crying out loud. Let's do this again. Let's just start it at the top. Let's not get started at the top, and then we'll copy this down and we'll keep that 0 in there for undeposited funds. Okay, that makes more sense. All right, now these two should probably be combined together, or that 0 should be removed. Even if there was something in it for external reporting, we would combine those together. But if you were to do this in like QuickBooks, you might be able to group some accounts together, although this undeposited funds becomes kind of a problem, which I won't get into here. But we're going to then underline here. Does this include all the numbers? It does. Notice we have a colon. We've got an indentation, double colon, to indicate that this is a subtotal. All right, then we have the property, plant, and equipment. By the way, I can check this number by selecting these. Adds up to 134,867. 134,867 looks like that part is correct. Now we got the property, plant, and equipment, the PP&E, the depreciable assets. Notice this time we've got the formatting that's a little different, because last time we only had one, which was called furniture and equipment, and then accumulated depreciation. This time we have two subtotals, furniture and equipment minus the accumulated depreciation, machinery and equipment minus the accumulated depreciation, noting we still need to do the adjusting entries, which we haven't yet done yet. But that means the formatting's a little different. So I'm going to grab these two down here, pull them down to give me a little bit more room, and say, okay, how do I want to format this? So I'm going to say, let's bring in the furniture and equipment, and then that'll be this balance. And then I'm going to say, let me bring in the accumulated depreciation. I'm going to say negative of this number, because I want to show it here positive, and then show that because normally we do a subtraction problem between these two. So I might say less accumulated depreciation with words rather than with the symbols. And then I'm going to put the total out here. Note that I could put the total over here, but then you would think I would need another column to indicate that I have now a subtotal within a subtotal and then another subtotal. I'm going to cheat a little bit in our normal formatting and just say I'm going to put the subtotal out here, which is going to be this minus this. So that's telling the reader, this is the furniture and equipment that we purchased. This is the accumulated depreciation thus far on the life of it. The difference between the two is the book value for that particular category. If you need more detail than that, you can go to the amortization schedules. And then I'm going to take this one, machinery and equipment, accumulated depreciation related to it, which we haven't yet calculated for the second month of operations, is this. And so this is going to be that. We'll indent these. Let's indent these. And maybe this should be double indented. And then underline. And then we'll subtract these two out. 5,000 minus that is going to be 5,000. And that's going to give us, I'll pull this back up. Our total property, plant, and equipment is the 90,500 plus the 5,000. So this is going to be equal to the sum. I'm not going to include this one up here, just these two, which is a little bit wonky for our formatting, for formatting's sake, but there it is. So now the total assets then are going to be equal to my current assets plus the property, plant, and equipment, which is here. Boom. I could check my subtotals, because this, and this should add up to, well, I subtract the 7,500, 95,500, 95,500. All of it from here to here should add up to 230,367, 230,367. Okay, now note, if there's a problem, usually the problem happens here because people put that contra asset account in the wrong way, and you'll have an error if that's the case. In other words, if I made this a positive and then I added it, it's going to be off. How can you figure that out? I could say, well, this should be the sum of this, right? And then I'm going to say this minus this equals this minus this is different by 15,000. If something went the wrong way, which is often the issue, I can say this is this divided by 2, and that'll allow you to say, oh, there's the 7,005. That went the wrong way somehow, right? That's a common problem. So if you ever have to do this manually, one thing you might do is check each section, get the total, and then divide the difference by 2 to see if you just had a sign that was going the wrong way, and then you could locate the number. So I'm going to say this needs to be a negative and a subtracted, and then that's down to 0. Okay, let's format this with blue and borders. Border blue for formatting's sake, and then we'll go to the liabilities. Liabilities are going to be accounts payable. We'll reset that, and then there's the 4008. And then I'll copy this down to here, and that goes down to payroll, and that's good because I don't need the unearned revenue. And I'm going to put these two into long-term liability, noting that when we get into the adjusting entry, we'll see that sometimes these loans have a current portion and a long-term portion if they're monthly loan payments. But I don't want to get into that right now. We'll talk more about that later. For right now, I'm going to imagine we're going to break those out into long-term. So I'll underline this for formatting's sake. Home tab font group underline. Summing it up looks MUI B to the N. Now this time I'm going to put both of these loans into one account over here called loan payable, whereas in my bookkeeping system I would break out each loan so that I can tie out each loan to the amortization schedule. Then when I do the financial statements, I would first do the adjusting entry, breaking out short-term and long-term, and then combined all short-term and long-term portions of the loan into one account for external reporting purposes, which if using software like a QuickBooks or Xero, you might be able to do with sub-accounts for QuickBooks. And for formatting, you have actually more formatting tools, which are a little bit more complicated to use, but give you more flexibility sometimes in something like a Xero. But I'm just going to say loan payable equals the sum of these two. Sum it up. All right, and then so that gives us our total long-term liabilities. So the total liabilities are the sum of those two. Again, I can check my subtotals. Adding these up should add up to 7,638, 7,638. These two should add up to 74878, 74878. All of them should add up to total liabilities 82,516, 82,516. Equity. Here's the tricky bit where I'm just going to say all of this should basically be in what I'm going to call owner's equity, and then I'm going to break out the difference between different equity accounts in the statement of owner's equity. So I'm just going to say this equals the sum of all the blue, dark blue as well as light blue, in one number. Okay, paso. Let's try it again. Equals the sum of all the blue stuff. All right, so there it is. So there we have that. Oh, I put it in this one. And then the total is going to be this plus this. Ba-boom. Okay. So that's going to be that. Now, notice that in like a QuickBooks, in this equity section, they're usually going to give you the detail of it. If it's a sole proprietorship, you're going to have the equity, and then you might have the draws, the investment accounts, if you have something in those two accounts, and then you're going to have the net income. Now, be careful here, though, because you would expect if you ran the financial statements, balance sheet and income statement for 1 month, the month of February, that you should have the net income, which would be in there calculated at 2,473. So usually QuickBooks will put it in there, but it's going to put it in there on a yearly basis. Why? It's going to give you the 2 months in there. So it's going to break out, or the equity is going to be lower by the net income, and then tell you, it's trying to indicate to you, hey, the income statement is part of the equity section, basically making a statement of equity within the balance sheet instead of it having a separate report for the statement of equity. And why does it do it on a yearly basis even when you want to make it on a monthly basis? Because QuickBooks is trying to, and Xero does this too, I believe, is trying to do the closing process for you. And therefore, it has to choose when it's going to do the closing. Is it going to do it weekly? Is it going to do it monthly? Is it going to do it yearly? Well, it does it yearly. That's what we told the system to do. So when it runs the balance sheet, it's always going to break out the year to date, which in our case is 2 months thus far of net income in the statement of equity, even though when I run the income statement for 1 month, it's only going to be this amount, right? So that's something, again, we want to kind of keep in mind how the formatting is going to work. Also, note that if I have owner's investment or draws, those are equity accounts that are going to show up in the statement of equity. Now, normally, those are accounts that we close out at least on a yearly basis or possibly on a monthly basis, right? If you're doing accounting on a book from like a textbook. But in QuickBooks, it doesn't automatically close out the owner's investments and owner's draws. Therefore, these two accounts will always be there for the lifetime of however many draws you took out or however many investments you put in as the owner. And they're only going to be adjusted if you manually adjust them, which you might only do like on a yearly type of basis. So that's just another thing to keep in mind. Also, if you were a partnership, then you're going to have separate owner's equity per partner. So you're going to have, instead of one owner's equity, you're going to have multiple equity accounts. If you had 5 partners, 5 equity accounts, and it would be kind of like accounts payable in that you basically have like a subledger within the equity section breaking out the value that is owed to the 5 partners, which of course might not be equal because they might not all be equal partners and might not have invested equal amounts as well as taking draws equally. That becomes a problem with software like a QuickBooks or Xero because you've got the net income that's going to be automatically put in this equity section, which is really not what you want to see when you have a partnership, because you want to allocate the net income to the capital accounts in accordance with the partnership agreement. So that's just another thing that's going to be a little bit messy. It's not too hard to work around, but just be aware of that. If you're a corporation, it's actually a little bit easier, except this account right here would simply be called retained earnings as opposed to the owner's equity account. It's a little bit easier than a partnership. That's why corporations were kind of invented, and that's because the ownership is going to be broken out by ownership. The draws then would not be draws, they would be dividends, and they would have to be, even across all shares. So you can have more dividends than another person because you have more shares, but it has to be an even number of dividends per share would be the idea, and the owner investments would be the capital investments from the issuance of the stock, is how the equity section might be broken out in a corporation. So the idea of the equity section in total is the same. It's how much is allocated to the owners. It's just that you might have one owner versus a partnership versus a corporation that has shareholders. All right. So then we're going to go to the income statement. Let's hide the balance sheet to do the income statement. I'm going to go from EV column over to the skinny over here. Right click and hide. All right, let's just reformat the income statement, which starts at the light blue. Revenue, I'm just going to say is equal to we have 3 revenue accounts: equipment, sales, service revenue. So I'll say enter. I'm going to pull this down one more. I need one more space. And so this is going to be equal to that one. And then we'll copy it down, selecting those, copy it down. So we have equipment, we've got sales, service revenue. Now notice what we don't have is a revenue account for every customer. That's going to be way too tedious. And in a software like a QuickBooks, we don't need it on the income statement because we can usually run a different report, which is going to break out the income by customer in a sub-report, which is great. We also don't have a separate account for everything we do in terms of every type of service or every type of guitar we sell, which would also be too tedious. And in a software like a QuickBooks or Xero, you can possibly run a subledger breaking out your income by the items that you sell, service or inventory. Therefore, again, you don't want to clutter your income statement. Notice the groups that we have here. we broke out the rental income because we wanted it as a big package subcategory versus the service revenue, which we're imagining were our guitar lessons possibly and other tune-ups and whatnot. And then the sales. The sales usually indicate sale of inventory, like the guitars themselves and the ukuleles that we sold. So I'm going to put an underline under here, and then we've got the cost of goods sold. Now it's a little wonky here because the cost of goods sold is only related to the expense of the sales. I'm going to make it a negative to flip the sign to show it as positive here, even though it's an expense, because I don't want to show negative signs here. I want it to be a positive and then use subtraction. All right, so this has its own subcategory, because if we sold just inventory, then the cost of goods sold is going to be the biggest expense, because that's the cost of the inventory that we're selling. That's why we have this subtotal along the way. Remember, in the income statement, in a single step income statement, it's very simple, just revenue minus expenses. If you have multiple steps, it's because we just want to have some pit stops along the way down to net income, right? So this is one of the big ones, because the relationship between cost of goods sold and revenue is vital for companies that mainly sell inventory. Let's say this is going to be equal to the internet expense. That's the next expense. And this is going to be equal or plus to the internet expense, but I want to flip the sign, so I'm going to double click on it and change that plus to negative. And then let's pull these down. I'm going to need a little bit more room, so I can select these two and just pull them down until we get to 0. So we don't need that one. And then I'll just pull this one back up. Boop, boop, boop. And then okay. So there we have it. And I should have other income and expense. Let's pull this one down again. And I'm going to pull these two down. And I'm going to pull this one up. Total operating. I'm going to call that one total operating, which is going to be the sum of this down to here. Okay, and then these two, I'm going to put them in a separate category. So I'll pull this one down again. And the reason I'm going to do that is because this would be the expenses. So let's put a subcategory here. Net income from operations is going to be another pit stop along the way that you might see oftentimes, which is going to be the last pit stop of gross profit minus this number. And so we're in a negative territory now. And then I'm going to pull this down again. And this time we're going to have other income, which is going to be other income, which is going to actually be a negative income and expenses. Other income and expenses. So, and then we'll have total. I'll copy this. Other income and expenses. Something like that, because these are things that we are financing charges, and they're charges on the gain of the sale of investment, things that don't happen all the time. In other words, we don't expect them to repeat possibly in the same way next year, or they're not part of the normal operations. Therefore, we're going to put them on the bottom down here, equals the sum of these two. And so there is that. And so net income is going to be equal to the last pit stop minus this one. And so that comes out to that. All right, now if I compare that to what I think it should be, what should it be? Equals the sum of these, the whole thing here. So that's what it should be. It's off. I can say, okay, what is it off by? This minus this. It's off by 1,520. Let's check every subtotal. So if I go up top and say, okay, these three should add up to these three, 14,854. And then up here I go, no, 14, that adds up to 14, but this is not correct because I need to pull this down. And so there, now we're in bound. Now that looks like it's the correct calculation. So I'm going to say, all right, that looks good. And let's put some blue borders around this. I'll make this blue. I'll make it bordered. And so there we have that. This should be double underlined, possibly, for formatting's sake. It's already double underlined. Okay. So that is that. All right. So then let's go to the statement of equity. Now the statement of equity, again, I could do this for the, I'm looking at the statement of equity for a 1 month time period here. So I'm going to say the beginning balance in owner's equity is going to be equal to this owner's equity here. Now this is a little wonky because remember, the investment actually happened last month. So if I was using like a QuickBooks or something like that, this is not going to close out unless I physically closed it out. So I'm going to keep this owner investment broken out in a separate account just so we can see it. But if I was closing everything out on a month-by-month basis, then I would say, well, this was closed out last month and I should close it out into equity, but I'm not going to do that. I'm not going to do that right here. So we're going to say 8.5 just so you could see where those things would be broken out. And then we've got the change in equity, which is going to be, I'll say the draws equals the draws. And then I'm going to say there's the draws and then the owner investment. Copy this down to the owner investment. And then the net income, which is going to be here. So now everything is accounted for here. The beginning balance of owner's equity is last period's ending balance of owner's equity, not having closed out the draws and investments because I'm going to break them out separately. That number, by the way, would be a problem if somebody went in and deleted something from a prior period, right? Like if I voided a check last period, which messed up last period's income statement, which then messed up the closing process for the beginning balance of owner's equity. If you do tax returns, then this is going to be a problem error that comes up if you do tax returns that have a balance sheet on it, right? Because you have to do that calculation. If you just do a Schedule C, people often mess things up because they don't do that calculation and they're just like, oh, whatever, I'll just take the income statement and I don't have the double entry accounting system because there's no balance sheet. But if you want to do a better job and you had a full service like QuickBooks system, you really should be rolling over the beginning balance equity to see if it ties out to the current period. And if it doesn't, think about doing an adjusting entry for it, right? But in any case, so we've got the 2, 3, 1, and then so we have the beginning balance, the draws that we took out, which is going to lower the equity. So it should come out to a total. Let me sum this up. It should come out to 147,851. So we're off. Why is it off? I think I messed up these numbers when I pulled them in. So the owner's draw was 0, and then the owner's investment was an increase of the 65,000. So there we have it. So now this accounts for this number, this accounts for this number, and this accounts for all of this in one number, 2473, which we pulled from the income statement, which is just mirroring all of this in a longer format for a multi-step income statement. So now we're at the 147,851. Let's unhide the balance sheet now, going from ET phone home to the FD, right click and unhide. So now we can check our numbers to some degree. We've got total assets, and maybe I'll pull this down a bit so it's kind of like lined up. So total assets equal total liabilities and equity. And then this equity ties out to the ending balance of the statement of equity, the report you often don't see in software like a QuickBooks or a Xero because they basically kind of stuff it into the equity over here. But if you have a more complex report for a corporation or a partnership with multiple partners, you may have to take the information from QuickBooks and then export it to Excel to get a little bit more formatting on the equity section depending on your needs. You might want to break out a statement of equity and partnership equity or corporate equity, and you can use the information on QuickBooks to give you that more detail in that way. But that's the idea here. Otherwise, it would be stuffed down here in the equity section, and then the net income on the statement of equity should tie out to the net income on the income statement. Now remember, in a QuickBooks system, this income statement, you can run multiple reports, a comparative report, and so on and so forth. You can also often convert from what you might call like a single step or simple income statement to a multiple step income statement and that will break out basically the sub accounts that you might be using. In Xero, you actually even have more flexibility to group accounts together or not group accounts together, and so on and so forth, although it's a little bit more complex. That's the trade-off between having a little bit more complex tool versus a simple tool. Sometimes it's easier. But anyways, I really like it once you get used to that. But anyways, so keep those things in mind, and that's going to be, and then in the software they're going to stuff in net income into the equity section, and you need to close out things like draws or investments. But if you don't, that's okay. You can kind of leave them hanging, but those are lifetime draws and lifetime investments then, which you need to adjust for possibly by exporting your reports to like an Excel and making some minor adjustments to the formatting of, say, the equity section is the general idea. So you have some different formatting options. Let's put an underline here. Is there anything else? I think that's basically it.